They're lying about the 2026 supercycle. And if you believe it without questioning it, the mistake won't show up today or next month. It'll show up the moment you realize you held through a full drawdown because someone convinced you the real top was still a year away. Because right now, you're being told one very specific thing, that the cycle didn't fail, it just moved, and if you accept that story, the cost isn't theoretical, the cost is you staying in while someone else quietly exits. Here's the uncomfortable part most people don't want to say out loud. The 4-year cycle didn't just bend, it embarrassed a lot of very confident people, and instead of admitting that, the narrative shifted. First, it was hold through Q4 and you'll be rewarded. Then it was, okay, maybe early next year. Now it's actually no, this is bigger, this is different, this is a super cycle, and the payoff is in 2026. That shift didn't happen because of new truth. It happened because expectations failed. And when expectations fail in markets, stories rush in to fill the gap. You felt it even if you didn't consciously name it. That moment where price didn't do what it was supposed to do. And instead of panic, there was reassurance. Calm voices telling you this is healthy, that nothing is wrong, that the real move is still ahead. Let me ask you something directly. If the cycle really is delayed, who benefits from you believing that right now? Sit with that for a second, because that question is the spine of this entire conversation. This isn't about being bearish. It's not about calling tops. It's not about telling you to sell or hold. It's about understanding why this specific story is being pushed by specific people at this specific moment. Because if you don't understand that, you're not analyzing the market, you're consuming marketing. Most people were taught that the 4-year cycle was almost mechanical. Halving happens, supply shock follows, mania arrives, blow off top, collapse, repeat. And for a long time, that story worked well enough that it became law in people's minds. So when Bitcoin pushed through its all-time high before the halving, something broke psychologically. That wasn't just a chart anomaly, that was a violation of a shared belief. Then, when the expected blow-off didn't come, the discomfort grew. Because markets don't like silence where certainty used to be. That's where the supercycle story steps in. It says, you weren't wrong, you were early. You didn't misread the cycle evolved. Nothing failed, it just upgraded. And that framing is powerful because it protects your identity as someone who gets it. But here's the thing, stories that protect identity are rarely neutral. Let's slow this down and really look at what changed. In past cycles, price action was driven by waves of retail speculation. Fast money, high leverage, short attention spans. Blow-off tops made sense because behavior was explosive. Now the market looks different. There are ETFs, there are balance sheets, there are compliance departments, there are quarterly reports. So the argument goes volatility compresses, cycles smooth out, and instead of a violent top, you get a long grind higher. On the surface, that sounds reasonable. And that's what makes it dangerous, because a story doesn't need to be false to be misleading. It just needs to be incomplete. Here's where my own thinking started to get uncomfortable. I've said before that the 4-year cycle was dead, and for a while I believed that confidently. The evidence seemed obvious, the timing was off, the behavior was different, the pattern didn't rhyme the way it used to. But then I asked myself a harder question. Was the cycle dead, or was my definition of it too rigid? Because cycles aren't clocks, they're reflections of behavior, and behavior didn't disappear. It changed hands. In 2021, behavior was loud and chaotic. In this cycle, behavior is quiet and patient. That doesn't mean there's no cycle. It means the rhythm isn't designed for you anymore. And that's where the supercycle narrative becomes convenient. Because if you're an institution accumulating slowly, you don't want retail front-running you, and you definitely don't want retail exiting early. You want belief. You want patience. You want time. So let's talk about liquidity, because that's the centerpiece of the bull case. Global liquidity is rising. Rate cuts are happening. Money is being printed again quietly, unevenly, and often in places people aren't paying attention to because the headlines are somewhere else. And historically, yes, Bitcoin has responded well to that. That part isn't made up. There is a real relationship there. But here's where the oversimplification creeps in. Liquidity doesn't hit markets on your schedule. It doesn't arrive neatly, and it doesn't ring a bell and say, okay, now price goes up. Liquidity moves in waves. It leaks. It pools in places you don't expect first. And sometimes it shows up long after the narrative told you it already should have. That delay matters more than people want to admit. Because when someone confidently tells you that rising liquidity guarantees higher prices in 2026, what they're actually asking you to do is very simple. They're asking you to stay exposed, stay patient, stay invested, and wait while the macro picture plays out. Wait while the lag catches up. Wait while the thesis proves itself. And waiting sounds reasonable until you zoom in on who waiting is easy for. Waiting is easy when you're managing billions. Waiting is easy when drawdowns don't change your lifestyle. Waiting is easy when time itself is an asset you're paid to consume. Waiting is harder when you're managing rent, when your patience has a cost, when every month that passes without movement feels like a question mark hanging over your decision. That's the asymmetry nobody puts in the slide decks. Nobody models emotional endurance and nobody prices in human fatigue. And that's before you even layer institutional demand on top of the liquidity story. Because yes, institutions are buying. ETF inflows are real. Balance sheets are absorbing supply. That part is visible, measurable, and undeniable. But here's the part that almost never gets said clearly enough. Institutions don't buy to make you rich. They don't buy because they believe in your timeline. They don't buy because they're emotionally invested in the outcome. They buy to create products. They buy to manage risk across portfolios. They buy because assets under management generate fees. And fees don't care how exciting price action is. They care that capital stays put. If price goes up slowly, that's ideal. Volatility compresses, drawdowns become survivable, redemptions slow down, assets remain under management. That's a healthy business. A violent blow off top followed by an 80% crash is not a healthy business. It destroys confidence, it scares clients, it invites regulation, it forces uncomfortable conversations. So ask yourself something honestly. If you were running a multi-trillion-dollar asset manager, what kind of market structure would you prefer? One that rewards patience, one that discourages timing, one where selling feels irresponsible and holding feels mature. That preference doesn't mean anyone is lying about everything, and it means incentives quietly shape the story being told. And incentives matter more than opinions. They matter more than predictions. They matter more than conviction. Now, this is where the goalposts start to move, and where people either wake up or dig in deeper. Every missed expectation gets reframed as confirmation that the real move is still ahead. First, it was this quarter, then it was next quarter, then it was next year. Now it's not even a delay anymore, it's a narrative reset. Same belief. New packaging. And at some point, you have to ask yourself a hard question. Is this analysis or is it coping dressed up as confidence? And I don't say that from above anyone. Everyone does it. Markets mess with your sense of time in ways nothing else really does. They blur patience and denial until they feel identical. They convince you that holding longer is always the mature choice. They make exiting feel like failure, even when it's rational. But not everyone is coping equally. There are voices warning that the last high may have been more important than people want to admit. That downside risk didn't disappear just because institutions showed up. That a prolonged distribution phase is possible, even likely. Those voices are quieter. They don't trend as well. They don't sell optimism. Hope is easier to market than uncertainty. Certainty spreads faster than caution. And that's what brings us to the conflict of interest. Most people wave away like it doesn't matter. Because when the loudest voices benefit from you staying in, you owe it to yourself to listen twice as carefully to the ones that don't. Asset managers earn fees based on assets held, not on your personal timing success. If you hold, they earn. If you sell, they don't. That doesn't make them evil. It makes them predictable. So when they tell you to zoom out, trust the process, and ignore short-term noise, remember who benefits from you doing exactly that. Again, this isn't about panic. It's about awareness. Now let me break the tension here because this is important. I'm not saying the supercycle is impossible. With real ETFs, global liquidity, and maturing infrastructure, the conditions for something different do exist. What I'm saying is that believing in a supercycle without questioning who's promoting it is how you stop thinking critically. Because this story has been told before. Different names, different logos, same emotional structure. This time is different. Institutions are here, volatility is gone, retail won't get shaken out. And every time, reality reminded people that markets don't exist to reward belief. They exist to transfer conviction. So where does that leave you? So this is where things land. Not in certainty, not in panic, but in an uncomfortable middle that most people hate sitting in. Because the 4-year cycle, at least as a clean, reliable playbook, failed. Not emotionally, structurally, the timing didn't line up, the volatility didn't show up the way it always had. The behavior of the market changed in ways that broke expectations instead of fulfilling them. And that matters, because for a long time, the cycle wasn't just a model, it was a psychological anchor. People planned their lives around it, and they delayed selling because of it. They took risk because of it. So when it didn't play out cleanly, it didn't just confuse people. It left a vacuum. But here's the mistake people make next. They jump from the cycle failed to cycles are gone. And those are not the same thing. Cycles don't disappear. They evolve, they get quieter, they stop announcing themselves. What really changed isn't the existence of cycles, it's who controls the tempo. Institutions are accumulating. That part is not debatable. The inflows are real. The supply is being absorbed. But accumulation is not the same thing as a pump. And this is where a lot of people get trapped, because accumulation can also be preparation. Preparation for long, slow distribution. Preparation for a market that moves sideways long enough to exhaust belief instead of rewarding it. That's the part most people don't emotionally price in. And this is where the asymmetry hits you directly. Institutions can sit through years of drawdown without blinking. They don't feel time the way you do. They don't feel pressure the way you do. If price goes down for 2 years, it's a line item. If price goes nowhere for 18 months, it's just patience. But for you, time is an abstract. Time is rent. Time is stress. Time is opportunity cost. Time is explaining to yourself why you're still holding something that hasn't rewarded you yet. They can wait. You have a life. So when someone confidently tells you to just hold because 2026 is the year, pause and ask a very specific question. Was that advice designed for someone with infinite patience and institutional backing, or someone with real constraints and real emotions? That single question will protect you more than any chart pattern ever could. And right here, in the middle of all this, I need to be absolutely clear. This might shock you, but I'm not a financial advisor and nothing in this video is financial advice. Cryptocurrencies are highly volatile and you could lose all the money you invest. You should always do your own research and consult a qualified professional. After all, your investments are entirely your responsibility and you should know that nothing is ever guaranteed when it comes to investing. Neither I, this channel, nor YouTube are liable for any losses. And this video is for entertainment and educational purposes only. Now let's keep going, because this is where things get subtle and where most people miss the real danger. The biggest lie about the 2026 supercycle is not that it can't happen, it's that it's being sold as inevitable. Markets don't move on certainty, they move on imbalance. They move when expectations are wrong. They move when positioning is lopsided. They move when belief outruns reality. If everyone believes the same future, that future stops being a surprise. And once it's no longer a surprise, it starts getting priced in quietly, early, and unevenly. That's the paradox nobody selling confidence wants to sit with. So think this through. If the entire market is aligned around holding until 2026, really think about what that means for everything between now and then, not the destination. the distance, because markets don't teleport from here to a future narrative, and they have to travel through months of lived experience. And that experience, most of the time, isn't explosive. It isn't dramatic. It isn't the kind of price action that makes headlines. It's a grind. Sideways weeks, slow pullbacks, rallies that stall right before they feel convincing, dips that don't quite feel scary enough to act on. Just enough movement to keep hope alive, just enough noise to keep attention hooked, just enough green candles to remind you why you believed in the story in the first place. And this is where patience starts to rot, not all at once, quietly, because patience without reinforcement isn't discipline, it's endurance. And endurance has a limit. When nothing meaningful happens for long enough, the mind starts looking for stimulation. You start checking charts more often, and you start listening to more opinions. You start asking whether you should be doing something instead of waiting. That's where frustration creeps in. And frustration doesn't announce itself as recklessness. It shows up as curiosity. What if I just adjust this a little? What if I rotate here? What if I take a small trade to feel involved again? That's how overtrading is born. Not from greed, from boredom mixed with uncertainty. And overtrading rarely feels like a mistake while it's happening. It feels like engagement. It feels like control, until it isn't. That's usually where real opportunity appears in markets. Not when everyone is confident, not when everyone agrees, not when belief is loud and unified, but when belief starts to quietly erode. When people stop trusting their own plan but don't fully admit it yet, when conviction thins out without collapsing, when the narrative still exists but fewer people feel anchored to it. That's the phase most people never talk about because it's not exciting. It's psychologically expensive, and it's exactly why narratives like the Supercycle are so powerful. They give people something to hold onto while nothing happens. But here's the reframe that changed how I look at all of this. Instead of asking, is there a supercycle? Ask something more uncomfortable. Who needs me to believe there is one? Sit with that question, because it doesn't give you an answer. It doesn't tell you what price will do. It doesn't predict the future. What it gives you is awareness. It pulls you out of prediction mode and puts you into positioning mode, because you don't actually need to be right about the future to win. You need to survive the present. You need flexibility. You need optionality. Optionality means you're not trapped by one outcome. It means you can adapt if reality doesn't cooperate with belief. The smartest investors aren't loyal to narratives. They're loyal to survival. They let stories inform them, but they don't let stories own them. They listen without surrendering judgment. They stay curious without becoming committed. They understand that institutions play a different game, on a different timeline, under different pressures. Institutions can afford to wait out years of stagnation. They can smooth returns. They can absorb drawdowns. They can explain patience to committees. Most individuals can't. And the smartest ones know the difference between long-term potential and short-term obligation. Potential is an opportunity. Obligation is a trap. So what do you actually do with this awareness? You stop outsourcing your conviction to louder voices. You stop letting timelines become part of your identity. You stop believing that holding forever is somehow more virtuous than managing risk. You give yourself permission to adapt, because markets don't reward loyalty. They reward responsiveness. They reward the ability to change your mind without self-destructing. If the supercycle happens, great. You'll be positioned without being emotionally trapped by it. If it doesn't, you won't be stuck holding belief instead of capital. That's the real edge. And if you want to keep sharpening this way of thinking, not what to think, but how to question narratives without getting emotional about them, there's a free educational Discord linked below where we break this stuff down calmly without hype. I also want to mention Cheeky School, because if you're serious about improving how you think about markets, psychology matters just as much as charts, and that's exactly what it focuses on. At the end of the day, the 2026 supercycle might be real, or it might be the most convenient story of this entire cycle. What matters is whether you're aware enough to tell the difference when it actually counts. Subscribe or watch the next video.